Okay, we now have Mr. Mustafa Wahab join us now to look at those developments in the in the global oil market. Thank you very much, Mr. Wahab, for joining us on the program. Good morning.
Good morning. Thank you, Chimeze and Ladi. I'm happy to be with you.
So tell me, what do you make of this multifaceted agreement by OPEC Plus? Was that in line with expectations?
I mean, absolutely, right? Market has actually been waiting, for the cartel to actually agree, on new production boosts, right? At least between August 2021 and down to the rest of 2021, right? If you recall, I mean, I think 2 weeks ago, UAE and Saudi Arabia was, more or less in a political battle, to sort of, decide whether or not they want to raise, output for UAE. I mean, that's their baseline. Right. I mean, at the end of the day, they were able to raise UAE's production baseline from 3.2 million barrels per day, to 3.6 million barrels per day, which is quite short from what UAE was actually accounting for, of around 3.8 million barrels per day. Right. So the impact of this, this sort of agreement is, probably was keeping oil price, particularly stable as we currently speak. Although, we've seen oil price, shedding some sort of anywhere between 1 to 2%. From Friday till today, and that's basically because of the higher production that is especially to be coming out from the OPEC and its allies. I think they've now basically agreed that they're now going to be boosting production by around 400,000 barrels per day, right, between now and the rest of the year up to April 2022. And obviously, this agreement is still subject to a review on a monthly basis, depending on what the dynamics of the market is concerned. But for us in Chapel Hill, we think it's a positive development, right? In our own point of view, we think this sort of output boost would essentially help meet the significant increase in consumption that we've been seeing in the last couple of months. I mean, if you recall, vaccination campaign has quite been successful globally. We've now started to see some sort of global macro landscape now gradually easing some sort of lockdowns that we've seen in the last couple of quarters. So the impact of this is supporting crude oil consumption, and we think that this new development would obviously help keep the market in a balanced position.
Okay, I would like to also know what it would mean, for the global market, more importantly for Nigeria.
I think Nigeria basically hasn't really benefited from this sort of significant higher oil prices that we've been seeing. And I'll put numbers to it, right? So, Ladi, if you check in Q1, what we saw was that oil price actually did roughly 31% higher, compared to the previous quarter. And in the same period, you saw oil proceeds for Nigeria declining by up to 23% on a quarter-on-quarter basis. I think oil produce is now down to $5.5 billion versus $6.1 billion that we saw in Q4 2020. And this is despite this sort of higher oil price environment that we're in. And the reason for this rapid deceleration in oil export proceeds for Nigeria is basically because of the fact that production for Nigeria is quite capped, to 1.5 million barrels per day, versus our history of production of roughly 2 million barrels per day, before the agreement was actually put in place. So, I mean, generally, we've not seen Nigeria benefiting, as much as we would like to see, which is mostly strictly coming from the, production cap that we have. And I suspect this is essentially the reason why, countries like UAE is also asking for a new baseline for their computation of their compliance, right? If Nigeria can also push this sort of agenda where the OPEC, and its allies would essentially allow, the country to raise its production baseline, then makes a lot of sense for us to see some sort of, accretion to oil export proceeds. But as far as we are concerned right now, things are still not very rosy, despite the fact that we're in an high oil price environment.
Now, Saudi Energy Minister Prince Abdulaziz bin Salman says OPEC Plus is here to stay. Now, for you, do you think OPEC Plus is still relevant, or do they have the capacity to keep the market balanced and, of course, obviously, oil prices?
I mean, Chimeze, you would agree with me that, the relevance of OPEC, it cannot even be debated, right? This time last year, when an environment where COVID outbreak, struck the global world, we saw consumption, decelerating significantly, and the impact of that, drove oil prices downward significantly. I think we were seeing oil price trading at around $25 per barrel. And all of a sudden, we just saw the cartel and its ally, came into the market to agree that they want to cut output by 9.7 million barrels per day. And we started to see the impact of that, essentially pushing, oil price higher. And they've been doing this in the last couple of years, right? What they basically do is that to ensure, markets continue to remain in balanced position, such that it sort of supports oil price at an elevated level, at the level where, the cartel and its allies, are well comfortable with, especially when it comes to, fiscal position, right? Again, the latest stress to the cartel that we saw was the new tussle between Saudi Arabia and UAE, which a lot of markets was already writing the obituary of OPEC and its allies. And clearly, over the weekend, what we saw was that they eventually agree on production cuts, to raise output by 400,000 barrels per day over the next couple of months, which basically shows that, OPEC and its allies, they are quite still relevant as far as global oil market is concerned.
All right, well, it actually hurts me that I missed that $25 buy for oil at that time. But anyway, Citigroup says Iran is the wild card in the oil market. What impact do you think Iran will have on oil prices?
Iran, was it Iran now? Okay, yeah. So the key concern really is for us in Chapel. We actually expected that, resumption of significant oil production for Iran would probably, undo some of the good works that we've done. You recall that, I think Iran has not even been able to push beyond, around 1.5 million barrels to 2 million barrels per day from the history of close to 6 million barrels per day that they've done before the sanction that was imposed by the U.S. government. So what we're thinking now is that, what we've started to see some sort of gradual, success, from talks between Iran and the U.S. and it's already yielding some sort of fruit. What we think is that by the time, Iran comes back to the market, they could boost output by another 2 million barrels per day. Which obviously for us in Chapel is another, downside risk as far as oil market is concerned. But I think the key question a lot of people are asking today is that whether or not OPEC and its allies will sort of include Iran to the new production cut agreement. What we think is that it's very unlikely. We checked, fiscal position or external position for Iran in the last couple of, in Q4 alone at least. What we saw was that the country is still in deficit of close to $4 billion, which basically means that, currency, inflation risk, as well as economic growth are still, not very strong for the country. So we think that the cartel will probably still exclude Iran from the production cut agreement and obviously allow the country to boost output so that it then supports its external position and obviously currency and perhaps as well inflation.
Right. So recently we have seen global inflation rise, particularly in the US and the UK. So with oil prices trending downwards, as we have seen this morning, what would that mean for global inflation trajectory? Is there any correlation between oil price and inflationary trajectory?
Yeah, if you check, global environment, what you basically see is that, higher crude oil prices typically translate directly to higher, PMS price products, especially in the US, in the UK, and obviously all those, Scandinavian, countries, right? So I think first of all, what you should put in mind, Chimeze, is that you all need to get used to higher oil price environment. I think this $70 per barrel levels is probably here to stay, and we'll probably see it, being the new normal at least in the next, couple of months. So the impact of this is obviously going to, continue to fuel inflationary environment, for the globe, right? So in terms of direct impact to Nigeria, obviously, in an ideal environment, when inflation is rising significantly in the US, what you basically see is that, Treasury yield, would probably follow in tandem, obviously move higher as well as inflation. And obviously you start to see the Fed, also exhibiting some sort of hawkish rendition. So for us, as far as portfolio flow is concerned in Nigeria, this is quite negative. Once yield in the US is starting to look attractive, you start to see investors move away, from emerging and frontier market down to developed markets where, yield are a lot more attractive and obviously, risk are a lot lower compared to what you see in emerging and frontier markets. And obviously, we're also in talks of whether or not Nigeria is going to do Eurobond in the next couple of quarters, which obviously mean that Eurobond is basically priced, is basically benchmarked at the levels that was, whatever levels we are seeing for the US, Treasury yield, right? Once, Treasury is starting to tick up, what that then means is that, Eurobond is probably going to price a lot higher, compared to, the previous levels. So, I mean, it's by and large, it's not really positive as far as, domestic impact is concerned for Nigeria.
All right, but talking about inflation, here in Nigeria, headline inflation, core and food inflation all declined, although, marginally, according to the NBS report released on Friday. But anecdotal evidence suggests strongly that domestic commodity prices have increased by almost 33% between the second quarter 2020 and 2021. For example, now the price of bread, one of the commodities, is now 600 naira from 300 naira, a year ago. So how can we justify the big difference between empirical data and market reality?
So Ladi, you are right? And I'll just put number to what you just said. On a month-on-month basis, what you actually see is that inflation actually ticked up slightly. And obviously, that's supporting the argument that food prices domestically in Nigeria is still quite elevated. The only reason why you are seeing the headline of inflation trending downward is just basically on a year-on-year basis, and that's basically because of the fact that we are coming from an high base effect. So it's purely high base, not necessarily because the structural environment in Nigeria is different from what we have last year, right? It's just purely a base effect impact. Right. So again, to buttress your point, month-on-month inflation is quite elevated, and it was largely driven by higher food prices, which obviously from cereal, vegetable prices, and obviously because of the fact that we are now approaching Muslim festive period, which is the Elayah period. And then the next key question becomes, where do we see inflation going forward, right? For us in Chapel, what we think is that year-on-year inflation is still probably going to continue to moderate. I think we're expecting inflation to touch around 17% in July 2021, and that's basically going to be driven by the high base impact from last year. But on a month-on-month basis, what we think is that inflation is still going to remain largely elevated, obviously because of the fact that we will now start to see this massive demand that typically comes with festive for Muslim Eid al-Kabir period, which essentially is going to push food prices higher for the month of July. Beyond July, what we think is that inflation will continue to moderate, obviously because of that high base impact from last year, and obviously because of the fact that we're also assuming that there is not going to be any major price shock as far as PMS price is concerned, and obviously on energy prices.
So how do you see the Central Bank's Monetary Policy Committee responding to this inflationary trajectory we're seeing, and of course the developments in the oil market when they meet next week?
I mean, for us, really, what we think is that, the CBN at the start of this year had basically mentioned that they can't do much, in curtailing the impact of inflation on Nigeria's economy. Obviously, because of the fact that the inflation trajectory that you are seeing today, they are basically structurally led inflation, not necessarily because of the fact that not necessarily monetary policy induced inflation. So what the CBN will basically focus on, as far as we are concerned, is to repair, the current gross FS liquidity that we're seeing in the market. I mean, if you check parallel market rates right now, I think we are roughly at around 505 naira to $1, which basically means that the CBN will basically tend to focus on repairing the current gross FSA liquidity in the market. What that means is that that would induce the CBN to sort of become a lot more hawkish compared to what we've seen in the last couple of quarters, right? This does not necessarily mean that the CBN would hike rates in the coming monetary policy sessions. What we think is that the CBN can employ the instrumentality of OMO, to essentially attract, FPI back into the country, which essentially is going to help solve this, gross FSA liquidity that we're seeing in Nigeria today. So what we're thinking in Chapel is that CBN would probably continue to exhibit some sort of hawkish rendition to ensure that normalcy is back to the FX market in Nigeria.
All right. We'll see how the CBN will go next week, what decision they'll take. All right, Mustafa Wahab, thank you so much for your time on Business Morning. Mustafa Wahab is oil and gas analyst at Chapel Hill Denham. Thank you so much.
Welcome. Thank you, Ladi and Chimeze.
All right, after the break, we look at the issue of road infrastructure development and refurbishment investment to tax the tax credit scheme. That's in a moment. Do stay with us. This is Business Morning.